AI surge feels familiar to anyone who's lived through the dot-com crash and the 2008 financial crisis. The excitement sounds new, but the emotions aren't. For retirees, remembering what came next in those cycles is critical.
Welcome to Leibel On Fire with Amazon best-selling author and Yields for You portfolio manager, Leibel Sternbach. Leibel On Fire is supported by our ETFs, Yields for You Strategy A, and Relative Strength Managed Volatility. Our mission is to help 1 million people retire with financial security. Now, the Financial Independence and Retirement Show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. It's Leibel On Fire.
Hi, everybody, and welcome to Leibel On Fire. I'm Freddie Bell, and I'm with the award-winning, the esteemed Leibel Sternbach. He's got a couple of books that are wonderful. Don't laugh, Leibel. Living with Financial Anxiety, and also the book entitled Authenticity. This is serious stuff, man. So the website is yieldsforyou.com. Leibel, hello and welcome.
Hey, how are you doing today?
Oh, just having some fun with you. I'm doing well. We want to talk about AI and the echoes of 2000 and 2008, what retirees should remember. So everybody's talking about AI. It comes up in all the conversations here lately. Is the AI surge like the late 1990s dot-com bubble, or is it truly something different this time? Will something explode and AI just take over the world and we're all upside down?
So I think it's a question I ask myself every single day, and I have yet to have a good answer. Some days I wake up and I'm like, oh, it's definitely a bubble. And other days I wake up and I'm like, no, this is a transformative technology. And there's a lot of talk on both sides of the aisle in terms of, is this a bubble? Is this not a bubble? Is there something real to it? Not a lot of people are talking about the comparison to the dot-com boom and bust. And there's, you got on the stock market side, some people, ask the question because you see the stock prices skyrocket. And they're trying to make the correlations of whether it's similar to what happened in 2000 or really in the 90s, right? And early 2000s. And the question is I don't know. We really don't know, because in the dot-com, the narrative was, all we have to do is get eyeballs, right? We build these websites, we build these tools, people will come, and they were getting people onto these websites, right? Don't get us wrong on that, right? There was a lot of all the metrics that people were looking at were being satisfied, but at the same time, it wasn't translating into revenue. And that was the big challenge, was that there was all these valuations based on something that eventually should have turned into something that would result in dollars, right? Because you need to take an investor's dollar and turn, $1 into $2 or $1 into $5. And the higher the valuation is, the more you have to turn that $1 into a bigger amount, right? An even larger and larger amount. Mm-hmm. And in the 90s, with the dot-com boom, we didn't really know what the future was going to look like. And there was a lot of bets being made, which is very similar to AI, right? A lot of bets being made. Nobody knows what it's going to be. The bust that came around was that there was these, massive valuations. And then, honestly, really, you started having, signs of stress, but then you had, 9/11. 9/11 kind of put the kibosh on everything. Whatever stress there was before, it just destroyed everything. Yeah. But the market was going down beforehand, and the market went down for several years. It took several years to collapse. It wasn't an overnight collapse like what we see right now. So when you're comparing AI to the dot-com era, is there comparisons? Are there similarities? Yes. Is there enough similarities to say that this is a bubble like that? I don't think you can say it's a bubble like that, but is it a bubble? I don't know. The definition of a bubble is a thing that you discover after it pops. Right? You don't know that you're in a bubble until afterwards. What I will say that is concerning to me is that there's more and more people talking about it being a bubble. And I actually just saw this morning an interesting interview with one of these tech billionaires, and he was talking about how they're building a different kind of chip, right, to compete with NVIDIA. And right now, NVIDIA is the dominant technology. There's another company that has another chip that they're, kind of dominant, but two companies control the entire world of AI, right? Like even China is buying, tens of thousands of these chips. No one else has the capability to really manufacture something that competes. And that's something that you didn't have in the 90s, right? In the 90s, anyone could throw up a website. Anyone could throw up a server farm, right? Like it wasn't a big deal to do it. And in fact, the one thing that actually had it like a moat was AOL, right? AOL had all of these call centers, all these dial-in centers that you could dial up to get access to the internet. And AOL, right, like they made really, they're still around, if you can believe that. They got bought several times, but they're there. But that infrastructure became meaningless, right? Because high-speed internet came along and it no longer required a dedicated phone connection and a modem to connect, right? And what I keep telling people is with AI, it's going to be some kind of transformative technology, right? You can't look at the technology we have today and say that's the technology that's going to be for the future. And so the similarity to a bubble, to the dot-com era boom and bust that I see happening right now is we're making this assumption that data centers are going to be the same, that the AI chips, that NVIDIA is going to still be able to have that mode, that Anthropic and OpenAI, right, and even Google, right, that they're going to be able to maintain their monopoly on these large language models. And that large language models are going to be the thing that's going to be for the next 20 years, right? Because these valuations require, 20 years of growth, like what Google has had, right? Google has dominated the search market for 25 years. They weren't, it's hard to think about Google that they are only really like 27 years old as a company, 28 years old. They didn't even get dominance until the 2000s. And so 25 years, right? That's a very short period of time when you talk about technology, right? Or when you talk about anything really lasting. So anyways, bringing this back around, right? Is it a bubble or a bust? When we talk about AI, the thing that I see happening is there's going to be a transformative technology, something that requires less power, that does it differently, that just nobody saw coming, just the same way that dial-up used to be the thing. And then now everyone's got like high-speed internet on their phone, right? It was a bunch of changing technologies that came along that transformed the way that people interacted with the internet. The internet itself fundamentally didn't change, but it was how we interact with the internet that changed. And I think the same thing is going to happen with AI, and we won't see it coming. And as soon as it happens, all these valuations are going to disappear.
So AI is an interactive technology. And I know there's some retirees who are listening to us right now, and they're wondering, well, Leibel, how does AI, with the speed that it has, with the intelligence that it has, what kind of impact can it have on my portfolio compared to what happened before when a lot of people lost a lot of money?
That is what keeps me up at night. And I'll be honest, right? It is one of those things, right? We have to, and I tell this to investors all the time, and I tell this to financial advisors, right? We need to make sure that we protect our downside, because what happens, right? The dot-com bust, right? Market went down. It took 3 years until it hit rock bottom, was down 55% from its, all-time high. And it took quite a number of years to recover, right? To me, that's a worst case scenario. And then by the time it recovered, we had like 1 or 2 years of recovery before we had the Great Recession with the housing crisis. And so when we talk about retirees, right, and our retirement portfolios, that is a massive risk, right? We don't have 5 years, we don't have 10 years to recover. So one, you got to make sure that you build in the ability that if the market does go down, right, it's not going to upset you financially that way. Number two, what if the market just keeps going up? It has that ability, right? There's a saying in investing, right, that you can't lose more than 100%, but you on the upside, there's an infinite amount of loss that you can have, right? And that's why shorting stocks is so risky, because the loss is infinite, right? Whereas if I just sold a stock, I just missed out on whatever recovered. Or if I own a stock, I can only lose the value that I had invested. But if I short it, right, which is essentially what we do when we take the risk off on the market, is we're shorting the market. right? The risk is infinite because it can keep going up and up and up and up. And the crazies, even if it's not true, right? The crazies can control the market, and they're very much demonstrating that they have control of the market. So there's a certain amount of our portfolio that we need to have at risk, which means that we need to have a certain amount of our portfolio that's not at risk. Because if everything's at risk, then a 50% loss or an 80% loss, right? That is a lifestyle change. We will not recover from that. What we need to be able to have is enough money that we can risk that so that we get the 100% upside. By the same token, right? If it takes 5 years or it takes 10 years for that to recover, it's not a catastrophic loss. It's not something that keeps us up at night. It is not something that has any material impact in how we enjoy these golden years, these years that we work so hard to get to.
Is that the lesson from 2000 and 2008 as a way to protect our security?
Yeah. And if you don't like hearing that lesson from me, then I'm going to channel Mark Cuban for you. Mark Cuban, he sold his company to Yahoo, right? He sold his company to Yahoo. He made $3 billion. When he sold that company, he turned around to, I think it was not Morgan Stanley, it was Chase, JP Morgan. He turned to his bankers and he said, he never had so much money in his life. And he said, I'm worried. He was paid in Yahoo stock. And he said, I'm worried about the stock going down. And this was 1999, and the stock was at an all-time high. I think it was $300 a share at that time. He turned around and he asked, how can you protect me? And so they got option contracts for him, which on $3 billion, it's not option contracts. It's a whole different instrument, but they gave him protection that if the market went down, if the price of Yahoo stock went down, he would be able to sell it at that higher valuation. And guess what happened, right? It went down and it never recovered, never came back, right? And Mark Cuban is a billionaire. Well, everyone else who owns Yahoo and, is trying to figure out what to do with it. And Verizon even bought it, right? And doesn't know what to do with it. So
Wow. So how can we learn more information about AI and how your company addresses itself to AI and the changes in the unknown?
Yeah. So the greatest way is book a call with us. Go on our website. We've got a whole bunch of videos. We've got a guide on it. We have an interactive tool that you can use. We got something called the 321 retirement plan, which is our philosophy: three buckets, two investment strategies, one plan. Go on there, and that's really our philosophy of how to protect against these unknowable exposures, right? These unknowable risks that can really upset our financial security. Because at the end of the day, right, we work so hard to get here. The last thing we want to do is risk our ability to enjoy this time, right? And we don't want to be, stay up all night, worrying about what's happening in the market or, who's the next head of state to get kidnapped.
Well, Leibel, you said at the outset that you're losing sleep over this, so get some rest and go to yieldsforyou.com. There's a lot of great information. And as Leibel said, there is information there for you. And you can also talk to one of these wonderful advisors at yieldsforyou.com. Thanks so much, Leibel. And we've seen that this kind of excitement we've seen it before in 2000 and again in 2008, as we said earlier. And thoughtful plans do tend to hold up over time. AI may be important, but as Leibel shared with us today, there is no need to rush. There's no need to react. We should act from. Balance and patience still do most of the heavy lifting in retirement.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yieldsforyou.com or call 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.